Hey, everybody, it's Jeff here once again with the Austin Top Guns podcast. Richard and myself are going to be on here talking today a little bit about what's going on in the economy, our views on recession, Richard's views on real estate and his update, really just talking about the Austin area. And hey, look at that. Richard's now got the Austin Top Guns or background too. So Richard, what's
Good morning.
what's going on in the real estate world right now with real estate and economics and everything else going on?
Well, it's real estate continues to be in flux like like it has been for years. Not as crazy as it has the last couple of years, but we've seen inventory building and a shift in a declining shift in values over the last year. So some 5% basically decrease in values that are out there across the board. So you see that, some areas, some areas vary from others, but kind of overall it's about a 5%. So it's become a better buyer's market, shifted more towards buyers, more favorable to buyers. Obviously with rising interest rates, over the last year, that was an impact to buyers and trying to figure out their buying power and what they could afford. But we've seen some stabilization in that too, kind of ticking around the 6.5% mark. Some days better, some days worse. It just depends on what you're looking at there. So I'm kind of interested to hear what you have to, what you're seeing and what you have to say from a financial perspective, what you're seeing towards the end of the year and into 2024, because we're seeing some different things in the housing market too. So I'm curious how those correlate. So
yeah, I mean, it all kind of fits together. I mean, I think when you're sitting here, you're looking at the interest rates, where they're at historically, and where they're at right now. I mean, actually, we're kind of at the normal that we've been in history when it comes to mortgage rates. I mean, we've seen them rise pretty dramatically here in the last year, but the reality was they were so stinkingly low for the longest time period that now they've kind of normalized back. I mean, albeit really fast, but they're at that point, and the Federal Reserve, has some control over that, but most of mortgage rates are really set by the market itself. They're set by demand. They're set, they're based on the 10-year Treasury, and the 10-year Treasury rises with the what's called the Fed funds rate. That's what the Federal Reserve controls, and so it'll kind of stabilize with that. So, I mean, we're at a point right now where, we had another 25 basis point rise yesterday. I personally think that's the last one for quite a while. Typically the Fed way overcorrects, and I think they have this time, and you're starting to see the little cracks in the system a little bit, leading us to a recession. And personally, I know a lot of the Fed watchers and all these people are saying that, we'll probably see a recession at the end of this year. I personally think we're in a recession right now. Most of the data that's used used to determine recessions is backward looking. So, we use the GDP figures, and if we have 2 negative quarters of GDP, it means we're in a recession. Well, I personally think we're there, and with some of the things that I watch. One of the big things that I watch is what's called the leading economic indicators. And basically what the leading economic indicators are is a series of 10 economic indicators that kind of are forward looking versus backward looking. Let me share my screen here real quick, and I can kind of show you what I'm talking about. And this is why I'm saying I think we're in a recession right now, and it'll be confirmed later on this year. Can you see that?
Yes.
Okay. So this first chart is basically in this decade, or these 2 decades that we're in right now. So from 2000 onward. The gray marks here are recessions that we were in. So this first one was the 2001 to 2002 recession. Certainly this was, we were already going into recession when 9/11 happened. it just exacerbated it even worse. And then the blue is changes to the index, the leading economic indicators index. The gray on the chart is the real GDP. And really the GDP, kind of went to zero effectively, but the leading economic indicators really pulled us or really showed that we were massively in the negative. Then of course, 2002, 2003, we saw a recovery leading into a period of time of just kind of gradual decline in those LEIs until, we hit 2007, 2008. And as you can see, this is not immediately a predictor of, okay, we're in the, we're in a recession at that point. It takes a little bit of time for those leading economic indicators to slow down and then, thus pulling down the GDP, which is, what we saw in 2007, 2008. Since that time period, basically we were kind of just muddling along pretty well. Then of course, COVID hit, boom, that went down. We had a little mini recession. And then we recovered massively. The economy recovered massively. And then you've seen it come down massively. One of the sharpest increases and declines. And, leading economic indicators are way below the line at this point, down, basically 6%, which is, to me, an indicator that, there's another gray box here that's actually starting to form right now, but it won't be shown by the Fed until, it won't be shown until GDP starts to show up that way.
Right.
A couple of things that are affecting that, financials right now, and the S&P 500, index of stock prices, which, the credit index and the stock prices are still positive at this point. But I don't think the market has started to take this in. What concerns me most are these two right here. Consumer expectations of business conditions and the ISM index of new orders are massively down. Most of these non-financial components are negative, except for manufacturers' new orders. And that's big ticket items, airplanes and things like that. Those tend to be the slowest to respond because, you don't decide to buy an airplane and then not buy it.
Right.
You pretty much are contracted to have to buy it. When those start to slow down, that's when big manufacturing starts to slow down. And typically that's where you start to see major layoffs. We're starting to see layoffs in the tech industry right now, but that's not that the tech industry tends to lead the pack on that. We haven't seen it start to spread out into the broader market yet. When that starts to spread out, it'll be when these new orders start to slow down for the big ticket items, because that's most of the manufacturing we do. And so the last chart is the conference committees. This is kind of where they will use that same chart on the previous page to indicate when we're in a recession. And it's been pretty damn accurate if you look at it throughout history, and it's indicating we're in a recession at this point. So, that said, what I'm doing with client portfolios at this point is really shoring stuff up, taking some things off the table, as far as the stock side of things. Even though the stock market's up, I want to not be pulling it out when the stock market's down. So we're shoring things up a little bit. We're using short-term treasuries as a balance point, because you saw the 10-year treasury is like 3.5%. A 1-year treasury I can buy for 5 or 4.9 to 5.2% right now. Mm-hmm. So we're in what's called an inverted yield curve, and that typically also indicates we'll have a recession in the next 18 months.
Well, and we've been having that discussion. It's a rolling discussion about when the recession was going to happen.
Yeah.
Early last year, we were talking about or hearing that it was going to happen end of last year, and that we were going to start seeing from a real estate perspective, we were going to start seeing the mortgage recovery or the real estate recovery. And the data shows historically that after we have a recession, that the mortgage rates stabilize and even pull back to some degree. So, and so we were looking at that. And so there was a conversation early last year that was going to happen mid this year. then it got moved to late this year,
Yep.
keep having those conversations. Some of the data that I'm seeing is kind of the same way where, we talked about the shift in market value where pricing has come down and been more favorable to buyers. At the same time, we're building inventory about 2.8 months overall.
Mm.
Balance market is supposedly 6 months, but we got to, there were a few, markets last year or year before that were, less than a month of inventory on hand. So it was
Yeah.
just, craziness out there. So
Where are
we're
we
seeing
where are we at now?
2.8
Okay.
overall across the city. So when you combine higher inventory, more
Mm.
inventory, and decreased sales price, I mean, obviously it becomes more of a buyer's market. The challenge was the interest rate,
Mm.
and people adjusting to the interest rate. A 1% increase in interest rate is a 12% impact on your purchasing power.
Yeah.
So if you start looking at, 2-3 percentage points and beyond, you're starting to see some significant impact on your purchasing power, which is taking a lot of people out of the market.
Mm.
So you have that situation going on. The prevailing thinking right now is that interest rates could stabilize through the rest of the year or could increase through the rest of the year. So I'm getting
Mm.
some people that are saying if you have the ability to lock in interest rates now,
Mm.
you should do it. If they're talking about that 6.5%, if we're seeing it yesterday, it was 6.375, 30-year conventional, good financing. If you see it dip down and you're in position to lock, then there's some advising out
Lock.
there to do that. So,
Yeah.
we had been talking to, there's a lot of mortgage people, a lot of real estate people were talking last year about ARMs and rate buy downs and all
Mm.
that kind of stuff, predicting that we would get past the recession and it would start correcting.
Mm.
And I was telling my clients, I said, if I knew the future, I'd be on a beach somewhere. But based on the prevailing interest information that's out there, sometime in the next few years, we're going to see that we're going to get past that recession and we're
Mhm.
going to start seeing some rate improvements. So, ideally, buying now and refinancing later makes sense. Just know that we don't know when that's going to happen. It could be a year, it could be 4 years. I mean, who knows? So,
Mm.
and kind of what you're talking about is that if we are in a recession, we're hoping that we can weather that through 2023 and start recovery in 2024 and
Mhm.
everything starts looking good again. So,
Well, and if you look at the Fed funds rate, I pulled up that chart for Fed funds rate because I think it's good to see, where we are historically. So
sure.
if you look back to the mid 50s, and I think that's always a good time period because prior to that, we didn't really have a good Fed system. That, the Federal Reserve wasn't as powerful as it is now as far as its ability to kind of control what's going on. So this is the Fed funds effective rate going back to 1955. Here's where we're at today. Yeah, we're basically kind of at that point that we're above where we were in the 1950s, not near as bad as we got through the 1970s. This was the peak ever, 15.72%. As of now, we're at 4.83% on the Fed funds rate. So I personally, if you look at history and you start to see, once again, the gray is recessions, you start to see the Fed realize, oh crap, we went too far, and they stop raising interest rates, but that still doesn't necessarily stop a recession from happening. And it's happened multiple times since 2000 and through 2008. They stopped raising interest rates because they were trying to slow things down, and then went, oh crap, we went too far, and they end up starting to let's start to adjust down. Let's start to adjust down at the point where at the point where we're starting to go into that recessionary period, and they're trying to stimulate the economy.
Well, and
So
your chart actually, basically tells what I just said about the
yeah.
fact of the correction after the recession. In some cases, it looks like it started right before. In some cases, it went through, but the data yields what we were talking
Yeah.
about.
Well,
The other,
and I think the biggest thing here too is, the Federal Reserve and really the entire monetary system was just at a point in time, or just something that hadn't existed in history. The Fed buying, forcing prices down, forcing interest rates down for a massively long period of time. You know,
Yes.
you have that 2009 to 2016 where effectively rates were zero. Here and in, you know, like in Europe, they were actually negative, which I
Mhm.
still have never been able to figure out why you would ever put money in a bank if you effectively had to you had to pay people to put money in a bank.
Yeah, have to
Yeah,
pay for
or pay the government to take your money, which is just
it.
insane. But you know, we've recovered some of that, but then once again during the pandemic, okay, let's just force rates down to zero again, and we have to get ourselves back to some normalization.
Well, I
Um,
thought it was interesting because, you know, I heard a discussion on this yesterday, and they were talking about the target being the 2%.
yeah,
And they were saying, you know, why 2%? And they said, well, actually, it's an arbitrary number. It doesn't necessarily
they
mean
literally
that
just picked it out of a hat. Yeah, I mean,
so
it's
that the
literally like, well,
2%.
that 2%
Yeah,
sounds good. Let's do it.
yeah. Let's do that. And so
Yeah,
the conversation is that, you know, if we're at 3.5, you know, for the next year, if we get into that range, is that really a negative or a bad thing? And
yeah.
so, you know, I get it's all in who you talk
I
to about whether
personally
that's
don't
true.
think it is. You know, I mean, historic inflation, if you look back to all, you know, since the beginning of time of them tracking it, historic inflation, and this is what we use in financial planning, is 3%.
Mhm.
So why the Fed picked this 2% idiotic rate, I have no idea. You know, I would say use a rate that's historically accurate of where it's been. 3% I'm comfortable with. That's what I build financial plans based on. So why wouldn't we use that rate, you know, across the board? And I think they're going to end up having to, they're going to be forced to that, because I just don't think it's possible with all that's going on. I mean, you've got the Fed trying to slow it down. You've got the government spending money like drunken sailors on the opposite side, you know, and what we haven't even talked about yet is we're facing a debt ceiling,
I
probably,
was
you know, around the beginning of June.
Well, that was the other thing I was going to talk about too, is you know, we can talk about all of this stuff, but if we don't get that dealt with, I
Yep.
mean, we're all going to be in a world of hurt, really.
Yeah.
So,
Well, and I mean,
uh,
it's going to be the same BS thing that they've done every time.
mhm,
We've seen this movie over and over again.
right.
So, all right, both sides dig their heels in, and you know, one says, "Hey, we need to cut the budget." The other one says, "No, well, we're not going to deal with you." And it's this fight back and forth, and they let the clock run out. Then they play the BS game of, and it's the same movie every time. Oh, we're going to have to shut the government down. So, you know, we're going to shut down all the national monuments in Washington because, you know, we just don't have the staff of volunteers
Mhm.
to staff the thing. And, you know, I thought during the 2011 government shutdown, my favorite part of that whole thing was when they shut down the World War II monument, and all these, you know, infirm 90-year-olds in wheelchairs went and they stormed the beaches at Normandy, and then they stormed the stupid government thing and took down the barriers so that they could actually visit before they die. So, you know, it's the same game, and then they're going to play this out over the summer, and then
Mhm.
we hit the fall and it becomes, you know, election season and everything else, and then they're miraculously going to deal with this and get it done. You know, so it's the same movie over and over and over again. It's just like Hollywood. They take the same storyline and just change it, you know, slightly.
Yeah, the interesting thing is when you talk about closing monuments and other stuff, you know,
Mm,
everybody's like, "Yeah, that's inconvenient," stuff like that. In
yeah.
the real estate world, it does impact us from a mortgage perspective.
Yeah.
Because I mean, we you know, just getting things done through mortgages is, you know, it, you know, really,
Well, yeah.
you don't
Yeah.
have people there to answer the phone and
Yeah.
responding,
FHA and all
and
that.
you
Yeah.
have
You got
then you
nobody
have
to, nobody to
backlog
deal
after
with it.
that.
Yeah.
So yeah, so that creates some challenges, but yeah, it's interesting. I mean,
Yeah.
the people keep talking about what's going on in Austin real estate, and it's like, you know, we've had a lot of changes. It's a roller coaster ride up and down based on, you know, what's happening in the United States and globally.
Mhm.
But you know, we still have significant demand on housing, you
Yeah.
know, and we're kind of at a blip right now where it's buyer friendly. But
Mhm.
you know, with you know, permitting, you know, new housing starts permitting trending potentially down. We're supposed to get some information on that soon. You've got lots of apartments coming online here in the near future, and you got a lot of existing homeowners that are not going to want to sell because they're loving
Mhm.
those rates that they got during that
Yeah.
time frame. So
I mean, I look at that myself. I'm like, I can't move. I have I think
Me too.
2.75% mortgage.
Yeah.
I'm not moving. I mean, good gore. Yeah, I could make money on my house, but then, do I have to downsize my house to make it, as affordable as I'm sitting on right now? So,
Absolutely. And you
yeah.
end up giving more money away. I mean, I think the average house payment right now is, I heard this stat was $3,200 or something
Okay.
like that. I was like, good
Yeah.
God,
It's
I mean, that's a
insane.
lot
Yeah.
of money. Yeah.
Yeah. I mean,
So,
that's almost almost $1,500 more than what I pay.
yeah. Well, I mean, we all
It's
have those
insane.
conversations, and it's like,
Yeah.
how do you manage that? And does it make sense to, I mean, it always boils down to lifestyle and what's going on in your life. And
Mhm.
that's what's, people need to buy houses, people need to, sell houses, and, it all boils down to that. And then it's just a matter of what do we maximize in the timing of that to get you
Mhm.
the best ROI.
Now, are
So,
we, how's the rental market? Are we seeing rents stabilize, or are they still on that, pretty high trajectory?
well, the challenging, we're seeing it. It was high. Excuse me. It was really increasing, and
Mhm.
then we saw it stabilize a little bit. But what's
Okay.
happening right now is you're seeing the taxes start to
Mm.
impact it, and so what's going to happen, I believe, is you're going to see it start increasing again, because the landlords, the investors are going to be like, we've got to cover this cost,
Well, you do. I
so
mean,
we're going to
it's,
pass it
yeah,
on.
we're passing it
So
on to you guys. And,
yeah,
until we see real estate rates, or real estate start to come back a little bit, which, I mean, I think you said you're seeing that now, but I mean, it's still, the prices are still pretty elevated.
well, and I mean,
Um,
I've had clients that have participated in multiple offer situations in the last month, so they're still
okay.
out there, believe it or
Okay.
not. There's still a lot of buyer, right now, the new construction's about 35% of the marketplace, with the builders selling off the inventory they've been building, and
Mm,
offering a lot of incentives.
okay.
So you're seeing that out there. So a lot of people don't like new construction, though. It just depends on your timing and
Mhm.
what you want.
Are
But
you seeing, are the builders continuing to build at the rate that they were, or are they slowing down?
they're slowing down. So
Okay.
yeah, that's part. I mean, that's kind of goes back to that, that permitting and stuff like that. We're
Yeah.
seeing. So you're honestly building into, kind of a perfect storm when you have people that won't sell because of their rates, right?
Yeah.
You got apartments coming online, you got builders, their starts are slowing down, and they're working through their inventory backlog, right? And you kind of look at all that, plus we have still high demand of people coming to Austin for all the various reasons that we know about. So you put all those together, and we're very quickly going to be shifting back into a strong seller's market.
Mhm.
So the indicators are, is now's the time to buy
Yeah.
before take the opportunity to go ahead and do that. I'm having that conversation with some of my clients that have been on the fence, or taking a shot here and there, but not really actively going at it. It's like, look, with you know really pricing in some areas coming down $100,000, kind of across the board. We've already seen that baked in. I know I've got some listings in my neighborhood right now. Well, I've got multiple listings across the city, but specifically in my neighborhood right now, it's a situation where, if we'd have sold at the beginning of last year or at the end of previous year, we probably would have got another 100K more out of those properties at
Yeah.
least. And so I've been having those conversations with my clients. It's like, we're not, and frankly, with the listing agents and some of when I'm doing the buy side, it's like, your pricing is,
Yeah.
a year ago, you're off for
Yeah.
a while.
Yeah.
And
You're
so
off by a
yeah,
year, and the client, yeah, I think the homeowners, it's like, okay, well, yeah, I know, my house was worth, I looked on Zillow a year ago and it was worth, $800,000. Well, it ain't anymore.
well, I had a house in my neighborhood I put up for sale last year in like October, and the same floor plan house 2 streets over, they had a nicer lot. We had an outdoor kitchen, stuff like that. But basically, my house was nicer. Their yard was nicer,
Mm.
but same floor plan. I went on the market. They were $135,000 more than my
Wow.
property when I went on the
Wow.
market, and I knew the agent probably hated me. I was keeping wary of what was going to drive
Mm.
bys and stuff, but we were on the market for 70 days, 60 something days,
Yeah.
and got it sold. And we came off of our sales price about 40K
Wow.
to get it sold. And I had a running battle with the VA appraiser on that. Nothing against VA appraisers, but I had a running battle on that one because somebody had done a fire sale a couple streets over the other way, and I was having to fight that. And so we kind of went through that, and then that house that was 135K above my listing ended up selling for 10,000 less than mine did.
Wow.
So, and it was just,
Yeah.
one of those things where they just rode the market down, and obviously they're on the market for a long period of time. But
Yeah.
you just have to, I mean, every time you have that conversation, you have to set those expectations with your clients.
But I think, yeah, and I think working with an experienced realtor, it's okay. This is what reality is, not, oh, well, I'm trying to, or I'm trying to impress my client and say that I can sell this for $135,000 above market. Well, just that's not reality. And I mean, even yours, you came down 40 and it still took 70 days to sell.
Yeah, it was. I mean, we got under contract twice. The first one went to the last day and opted out, but
yeah,
I mean that happens. So it's one of those things where, and frankly, our market was declining while we were on the market. So that was another thing. But I thought I got ahead of it pretty good on that one, and frankly, I think I did. And my clients,
well, I think you still did. I mean,
yeah, my clients were happy. So,
yeah.
But it was one of those deals where, I always tell my clients, it's like, I know what you want to sell. I mean, I've walked away. I mean, it's one of those things where I'm not, it's not what I'm wanting to do. It's what the data tells us. And, this is the trend analysis of the neighborhood. This is what the data is showing. Am I willing to, it's a strategy to push it a little bit at times. Let's talk about that. It's ultimately your decision. But if, we get crazy above the numbers, you don't position it right. The data shows it's going to cost you money in the long run. So,
yeah, absolutely.
Yeah.
Well, I think, the last thing I wanted to talk about, and I want your feedback on this as far as how it affects real estate, on the residential side, is what's going on with the regional banks across the country. In your world, are you dealing with them, with clients, or is it mainly FHA and some of the governmental programs, or large banks that you're dealing with?
Well, a little bit of a loaded question because my brother is a senior VP at Chase, and so in the mortgage division. I personally don't recommend big banks. I try to stay away from big banks. Part of it is because there's local mortgage companies that I can walk into their office. They have a local underwriting, all of that stuff to make things happen. Typically what happens is if you're dealing with a big bank, it usually only works if you're, like an Apple employee or something like that, where you have, they're going to take care of you because you're an Apple employee. So you're not going to have any problems. If you're, Billy Joe Bob on the street, then you may not get, you're not going to get that kind of service. So usually we're doing more regional mortgage players like that, that we work with. Regional banks, in most cases, I don't get involved with unless I'm doing my land development deals or, purchasing farm and ranch or things like that. That's where I touch them, is that I know that that's kind of a non-traditional for, typical mortgage companies and stuff like that. So we go to them for those types of investments and assets. But there is a lot of conversation about the regionals getting bought up out there. It's probably more your world than mine, but it's, we're seeing that happen. And I don't know. So
yeah, I mean, so my take on it is, I think people need to calm down a little bit about the banks. And I look at banking from two perspectives. As a depositor, If you have less than $250,000 in the bank as an individual, or $500,000 as a couple,
Mhm.
your money is completely safe. It's backed by the FDIC insurance. We are not back in the 1930s. That's why FDIC was created, was to provide a stabilizing vehicle. The other thing that's, it's funny because I hear from clients, I hear from people, oh my God, the government's bailing out all these banks. No, they're not. That's what FDIC was created for, was to balance this out. And the Federal Reserve was created to be able to stabilize the banking market by making low interest loans to banks so that they can, stabilize things. Now, what's going on is kind of a couple things that have affected banks. Interest rates have risen massively. We saw that on that chart. It's one of the fastest rises of interest rates that we've seen in history. So a lot of banks wrote mortgages and wrote commercial loans at incredibly low rates. We already said, 2.75%, some cases 1 point something percent for really large commercial projects. Interest rates go up, and the banks are going, well, we can't afford to offer, higher interest rates to our share, to our depositors, because we've got a margin that we've got to keep in that case. And what's happened is you've started to see depositors shift money out of, hey, I'm making 2% or, less than 1% in my bank account. I can go out here and buy a treasury or a CD or something like that, where I might be able to get upwards of 5%. So there was that shift. And then what's happened is it's accelerated with Silicon Valley dropping off, Signature Bank. People are now scared that they're going to lose their money and it's going to be like the 1930s all over again. So I, once again, state the point: if you have that money that's in a bank that's under the FDIC limits, your money is completely safe, and there is no reason to panic or scramble or run. There's plenty of absorption in the banking system to be able to take over. There are thousands and thousands of regional banks. We are going to see some fail. We're going to see a lot more fail, I personally think, because what hasn't been factored in, I think, is the renewal of loans in the case of commercial. And, the pandemic made a massive shift. We've had a shift in the whole office environment type of, work environment for the last 20 years. It just got accelerated massively during the pandemic, where more people are working from home. These businesses do not need the square footage that they have. Well, it's already been built and bought and paid for at this point. And so that, I think, is going to, and that's largely the realm of those regional banks. They do a lot of commercial loans, and I think that's the next shoe to fall. So as a depositor, you don't have any worries. If you are an investor in banks, I would rethink my strategy a little bit, on my personal portfolios, because I run portfolios based on sectors. I'm basically running portfolios with almost zero exposure to financials right now, because I just don't want to play in that world. There's other areas of the markets, and once again, I'm playing more of a prevent defense than anything at this point, of saying, okay, I don't want to see, I'm trying to protect client monies. I'm not going to cash, but I am pulling back on the areas that are much more economically sensitive, that won't do as well in recessionary time periods. And, instead of being in cash, we're using short-term treasury ladders. So, we might have a 3, 6, 9, and 12-month treasury, which, all of those are, sub 5%, but, significantly better than sitting in a cash account where you're making less than 1% right now.
And that was kind of the point I was thinking about too, from the layman standpoint, is that yes, FDIC is there, so you have that protection. So I think about that myself. At the same time, it's one of those things where if you don't want that much money just sitting in a bank anyway.
Yeah, I know. Like, why you would have $250,000 sitting just
Yeah. So
doing
it's,
nothing. Yeah.
so I mean, realistically, if you're being smart about it, the money that you have in your bank and have access to your liquid money
Mm,
is protected. The rest
yeah.
of it, you just have to figure out where's the best place to invest it to protect it and also get
Mm,
some return out of it. So,
absolutely.
yeah.
So, that was the point I wanted to make, that if you're an investor in banks, you need to rethink your strategy a little bit. If you're a depositor, you're fine. I've heard, oh, the taxpayer is bailing out. No, the taxpayer isn't bailing out. However, as a owner or as a depositor in banks, the FDIC insurance is paid by the banks. So they're the ones that pay into the system to insure your deposits. With the failures that have happened in the backing of the FDIC, that's going to affect the premiums that the banks are paying. And that means that in fees and reduced interest rates, we're all paying for it at that point. So we're not paying it as taxpayers, but we're paying it as depositors at that point. So, that's what you need to understand about that. And just wanted to make that point. If you look, there's another, there's a Sense of Things podcast that I posted in the Austin Top Guns group that just happened yesterday with a friend of mine that we run that podcast, and we really go into this in much more gory detail if you really want more detail on this than we've given you on this podcast. But so I think that's all I had today. Richard, how about you?
Well, I could go on about real estate. You
Oh,
know how
I know.
that is.
Yeah,
But
I could talk about this stuff forever. But yeah, if you
but
want more gory
yeah,
detail, go to the
yeah,
Sense of Things
yeah.
podcast that we have on there. But thanks a lot, folks, for listening in today. I hope this was helpful for you. Certainly give us comments, share your comments, thoughts, questions. Certainly share with us what you want to hear. And we're actually starting to talk to people that are part of the Top Guns group to bring them on to talk about their areas of expertise and what they're seeing. So thanks a lot, and we'll see you guys back here the very next time.
Have a good day.